A recession has started, and so is the damage control. I'm your host, Steve Van Metre, and thanks for joining me today. And for months, we've been talking about high inflation would quickly become a political issue, and the day is here now. With the Fed set to hike policy rates by 75 basis points on Wednesday, we're already seeing damage control from the White House saying perhaps the worst may be behind us. But are policymakers wrong? Well, it appears they are, because the worst is yet to come. Let's head over to the White House, where they blog this week by saying, how do economists determine whether the economy is in a recession? What is a recession, they ask? While some maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. Well, is it? Well, according to the dictionary, a recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP for 2 successive quarters, suggesting from the White House that we are about to see a second quarter negative print for GDP growth. But not to outdo the dictionary, the IMF, or International Monetary Fund, back in 2009 noted the definition of recession was 2 consecutive quarters of decline in a country's real or inflation-adjusted gross domestic product. But facts aside, instead, both official determinations of recession and economists' assessment of economic activity are based on a holistic look at the data, including the labor market, consumer and business spending, industrial production, and incomes. Based on these data, it is unlikely that the decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession. Well, I'll take that challenge. Let's head over to the charts and see if that data suggests we are indeed heading to a recession, or perhaps, as the White House suggests, the worst may be behind us. Let's start out with the 4-week moving average initial claims, and these are your initial unemployment claims smoothed over a 4-week period. And we've gone back in time to note that there is no consistent level, and you'll see in yellow where I've marked where recessions start, at least officially, and there's no consistent level that would have to be reached. In fact, what happens is a recession starts as unemployment claims move off of their lows. Now, sometimes, as we see here in the late 60s, and mid 70s, that it didn't take a big move, or even here in the 80s it took a little bit bigger move. It doesn't have to take much, but sometimes, as you can see here in the late 80s, it took a much larger move. And what we have to note now is we're coming off lows, suggesting that we are much closer to a recession than not. But how about the labor market? Outside of initial claims, we like to hear about from the government about how hiring matters, and the total non-farm payrolls is all that matters, because it doesn't matter if people are losing jobs as long as they can find another one. And when we look at the history of the total non-farm payroll, what's key is to note that it's a slowdown in hiring that leads to recession. Here you see I've marked them in yellow. Now, I had to cut off the recent data because the pandemic data throws this chart off where we couldn't read it. But notably, what we're looking for here is we've seen recently a 400,000 print of the non-farm labor payroll data, and what we're looking for is a slowdown of that data. It could be 300,000, could be 350,000 coming up. As long as it continues to slow down, that is what we're looking for. And you can see historically, slowdowns in payroll data every time lead to recession, suggesting the worst indeed is yet to come. But how about the factory sector? As the government mentions industrial production, well, let's first look at the Philly Fed current general activity. This is, again, a Fed survey, and want to note that going into recessions, there's usually a sharp drop-off in general activity in the manufacturing sector, and you can see that here every time. Now, this data is fairly noisy, but nevertheless, it suggests that here recently we're seeing a steep drop-off. In fact, one of the fastest drops in history going into contraction, suggesting that we are indeed headed into a recession. But what about when we overlay the industrial production data? As the White House mentioned, is important, but it's also a very lagging indicator to the Philly Fed manufacturing survey. And you can see the Philly Fed data leads industrial production in red down every time, suggesting industrial production is indeed going to come crashing down. And the National Bureau of Economic Research, or NBER, Business Cycle Dating Committee, the official recession scorekeeper, defines a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. The variables the committee typically tracks include real personal income minus government transfers, employment, various forms of real consumer spending, and industrial production. Notably, there are no fixed rules, that's just true, or thresholds that trigger a determination of a decline, although the committee does note that in recent decades they've given more weight to real personal income, less transfers, and payroll employment. Well, as you can guess, let's take a look at what we've got on that. Here we see average hourly earnings of all employees less the consumer price index on a year-over-year on a percentage change, which shows, of course, real or inflation-adjusted personal incomes. And what do we note here? There is indeed a slowdown, and you see leading into recession, and a slowdown here leading into recession. Consumers are indeed in deep trouble, suggesting we are, in fact, in the early stage of recession. And also because the committee depends on government statistics that are reported at various lags, which is true, it cannot officially designate a recession until after it starts. Also true, but how might the Enberg committee assess the health of the economy? Well, let's first look at footnote 1, which says, in fact, when recessions are short-lived, as policymakers are hoping right now, the committee typically announces them after they're over, suggesting perhaps that we may have already been in a recession, and now it's gone. But recession probabilities are never zero. This is also true, but trends in the data through the first half of this year used to determine a recession are not indicating a downturn. In fact, due to the lags of the government data, they're absolutely showing that we are in the early stages of a downturn. Now, if you're concerned at all what this means for your portfolio and that the government could be wrong and that we're headed into a deeper recession as money managers double down on their risk bets, well, there's one strategy that hedges this portfolio with bonds because interest rates crash during recessions. That's Portfolio Shield. I'll put a link up here in the corner and description below. Well, let's head over to what our Treasury Secretary, former Fed Chair Janet Yellen says. There's signs of U.S. recession aren't in sight for now, as she says the Fed will succeed in its inflation flight and would be amazed if Enberg were to declare a formal recession. Well, Yellen, you're going to be amazed. We're likely to see some slowing of job creation, Yellen said on NBC's Meet the Press on Sunday. I don't think that's a recession. A recession is broad-based weakness in the economy. We're not seeing that now, but the factory sector is a big indicator that we're about to see just exactly that, Miss Yellen. And I would be amazed if Enberg would declare this period to be a recession, even if it happens to have 2 quarters of negative growth, again, validating that perhaps the data says we will see a second quarter minus print. Well, we've got a very strong labor market. When you're creating almost 400,000 jobs a month, that is not a recession. Well, Ms. Yellen, that indeed could be a recession because it's not the number of jobs created, it's the rate of jobs created. In this case, we continue to see a slowing trend. In fact, when we get the next non-farm payroll report with an increase in unemployment claims, it's likely that we're going to see an even slower hiring pace. But when in doubt, we head over to our chief economist, Jeff Snyder, who headlines in his recent daily brief, which you can get for free for a limited time. There's a link in the description below. And he says, according to the recent PMI data, that the S&P Global's U.S. manufacturing PMI was better of today's big bunch, only falling 0.4 points in July at 52.3. However, this overstates the manufacturing situation given its key components from new orders to outputs are now below 50. Meanwhile, the services index simply crashed, falling almost 6 points to 47, bringing the composite to 47.5. And he says that financial markets and curves have been warning about not just recession, but one that might arrive sooner than most expect. Of those who do, dig in faster while hitting harder. There continues to be vocal, perhaps minority, particularly across the financial services industry, trying to reassure nervous investors who maintain that this is little more than a necessary slowdown engineered by the Fed, no less, to get control over inflation. And again, if you want to hear more what our chief strategist has to say, be sure to check out that link below. You get your next report 8:30 a.m. on Tuesday. Let's continue on because Summers, a former Treasury chief, says Fed needs to take strong action to curb inflation, and he says there's also a high likelihood of recession in the U.S. Someone who's not in office now that gets it. There's a very high likelihood of recession when you've been in this kind of situation before, according to Summers, a Harvard University professor and paid contributor to Bloomberg Television. Recession has essentially always followed when inflation has been high and our employment has been low, and he's got that right on. And what matters now is what the Fed's going to do on Wednesday. As we head over to the Wall Street Journal with this headline by Nick Timmerus, the Fed whisperer as the U.S. risks deeper downturn if the Fed has to fight inflation alone, and steps to make economy more resilient to shocks, particularly from energy, could ease the threat of severe recession, but he notes that Fed officials are expected to raise interest rates Wednesday by 0.75%, which would bring their benchmark rate to range between 2.25% and 2.5%. And there's only one person right now that knows exactly what the Fed seems to do, because he's got an inside track, and that's Nick over the Wall Street Journal. So we'll be watching him between now and Wednesday before the official announcement. But at the Fed's current trajectory, the White House is going to have to do more damage control, because it looks like we're not only just headed into a recession, but a deflationary recession. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.